of financial management. In today's class, we shall continue with our lecture on cost of capital. Class, cost of capital. Please, can someone just remind us what we did in our previous class? Can someone just walk us through what we did in our previous class? Who is that? Okay. Can someone just walk us through what we did in our previous class? How we started cost of capital? Hello. Nobody. Okay. Let me start from Joy.
Hello, good evening.
Yeah, good evening.
Good evening, everyone.
Good evening.
Okay. Last week we started with cost of capital, and we said that cost of capital is the minimum required returns that investors are expecting from investments. So we also said that cost of capital is divided into equity and debt. So we walked through cost of equity, and we said that cost of equity can be calculated using a dividend valuation model, the CAPM method of estimating the cost of equity, and we have the last one, Modeglam and Miller, MIM. So you also
Yeah.
so you also said that you'll be focusing on dividend valuation and the CAPM method. So we also walk down to the formulas in calculating the dividend valuation model. So we did the dividend valuation with growth and dividend valuation without growth, and we also share the formulas that we can use to calculate them. Then you also talk about method of calculating growth rates. So we have a two method: extrapolation of historical growth and Gordon's growth model, and we also push us through with the formulas to use in calculating it. So we wanted to talk about Gordon's growth model. We said we should go back and learn those formulas before we move forward.
Wow. Wow. Awesome. Makes sense. Wow. Okay, Joy, I have something for you. Joy. Do you have the material? Joy. Do you have the material?
Not yet, sir. Not yet, sir.
Okay. So I'm giving you the material free. Right? I'm giving you the material for free. Just share your email with me immediately after the class. You get, so you don't need to pay anything from the beginning of what is it called, FM, to the end. You have access to the material. Joy, well done.
Thank you, sir.
Yeah, well done. All right, distinguished professional colleagues, I think that's a very good one from Joy, right? And class, it is what it is. For those who have actually go back to what we did in our previous lecture, congratulations. And for those who just look at it, that is it not this cost of capital? As we move, we talk more about cost of capital. Cost of capital is the foundation of financial, is the financial foundation of financial management, because there's nothing we want to talk about as we move from this stage to another that will not mention cost of capital, right? So please, we are here to, of course, I'll share the material tonight. For those who have actually made their payment, they will get it actually. And yes, we get the material today. Now, what quickly take us to, what bring us to take us to the cost of capital, right? You actually forgot to explain what take us to cost of capital. You know, we wanted to do working capital. Then I changed my mind and say, no, let's follow the trend. And what is the trend? The function of a financial manager. Who is this? The buyer now. Meet your mic. See, that is why. Okay, let me meet. I'm coming. I know what to do. Oh, where is this? Turn off mic. Okay. So if you want to talk, you can just make use of the chat button. Thank you. So, and we need to follow the trend. And the question is, what is the trend? We should not equally forget that we started from function of a financial manager. Class, started from function of a financial manager. No, from the definition of a financial manager to objective to function of a financial manager, right? Now, the function of the financial manager are investment, are to make an investment decision, financing decision, and dividend decision. In some other texts, you will have the risk management. And I said that the investment decision, you need to identify a project that is viable. When you identify a project that is viable, when you identify a project that is viable, you now think of how to finance the project. You now think of what? How to finance the project. How to finance the project will take us to financing decision. Class. And this financing decision is the sources of finance. That is, you've already, as a financial manager, you've already identified a project that is viable. Now, the next step is, how do we finance the project? Now, are we going by equity or by debt? So this now leads us to the cost of capital. That is, cost of capital is divided into two. It is what the investors are expecting from their investment and requiring the what, and it is also requiring the company to pay back interest and principal to the debt holder at the what, at the date of maturity. So that is why cost of capital is divided into two. You can see the first definition goes with equity. The second definition goes with what? Debt. And we equally explain that it is a cost to the firm. It is a return to the what? To the equity holder or the debt holder, right? And we talk about the reason why, Joy, you forgot to mention the reason why cost of equity is usually higher than the debt, right? Now, from there we move that dividend valuation method. Under cost of equity, you have the dividend valuation method, the capital asset pricing model, and the Modigliani Amida. And I said, okay, we can ignore that Modigliani Amida, we can keep it separate and move to the other part, which is the dividend valuation and the capital asset pricing model. I equally explained that the method to be used will be determined by the question or the requirement, the question itself. Under the dividend valuation method, there are two methods: the dividend without growth and the dividend with growth. Class, when there is a dividend with growth, there is a formula for that, which is the KE equals to D1 divided by the market value S div. I say if it is S div, it means that the dividend has been paid. When they said they have paid this dividend, definitely you will have a market value S div. Now, I equally explained that if they say declare dividend, if they say they declare dividend does not mean that the dividend has been paid. If they declare dividend of 50 naira and they said the market value is 20, the market value is 100 naira. You know, they just declare dividend and the market price is 100 naira. That market price, it is cum div. It means that the dividend is yet to be paid. Right? It means that what? The dividend is what? Is yet to be what? Is yet to be paid. Class, am I communicating, please? Am I communicating? It means that the dividend is yet to be what? The dividend is yet to be paid. Now, we quickly move to with growth. That is cost of equity. Sometimes when you have a series of dividend, you can equally say, oh, there is dividend with growth. Now, the question you should ask yourself is that which of these growth are we using? Because there is a formula for calculating the cost of equity with growth. Then the growth rate itself will not be given to you in the question. And I said, oh, for you to calculate this growth rate, there are two methods. The extrapolation, which is the historical method or geometric method, and the Gordon's growth model. I equally explained that when you are given a series of dividend like this, as shown in my screen, 2023, 2022, and 2021, there is a series of dividend. Can you see? Now, another explained that when you have n-1, it means that in 2023, there is no growth in dividend because you don't have 2024. That is why you will say, okay, how many years is 5? If 3 years, 3 minus 1. That is the reason why you have n-1. I equally explained that what if you are given only the current dividend? You're not given a series of dividend like this so that you will not minus 1. They can just give you current dividend to be this, then the earliest dividend should be this. So you don't need to minus 1. So definitely the formula will change to be n. N is how many years? 2 years. Current dividend divided by the earliest dividend minus what? Minus 1. So this gives us the what? The extrapolation, the growth rate. Class. When you're given a series of dividend in 3 years like this, or 4 years or 5 years, you know, oh, this is extrapolation. You have to do n-1 because there is no growth from 2023. If there is a growth from 2023 to 2024, 2024 is not given. So you don't know if there will be a growth in dividend from 2023 to 2024. But in a situation whereby you're just given the current dividend and the earliest dividend, so you don't need to minus 1. Because they've given you that this is the current dividend, and this is the earliest dividend. Now, the Gordon's growth model. The Gordon's growth model is a method of estimating growth rate. Now, if you want to estimate a growth rate, class, if you want to estimate growth rates, using either extrapolation or Gordon, the question, right? If it is not stated that, oh, use the dividend valuation model or use capital asset pricing model, we'll get to that part. Or so what I'm trying to say is that the either extrapolation or Gordon's, it is the question that will point which of these you are to use to determine, to estimate your growth rate under the dividend with growth. That is why you need to pay attention. Now, the Gordon's growth model. What is the Gordon's growth model? Gordon's growth model is similar to the dividend growth model. Now, with the expectation that with the difference that the expected growth in annual dividend is calculated from the what? Earnings. Now, class, a company will not pay you dividend if they don't make a profit. So therefore, dividend is paid from their earnings. Class. So Gordon's growth model make use of accounting profit, because without that accounting profit, your dividend will not be paid. If you make a loss, the company will not pay the ordinary shareholder. They won't pay them. That is why they are risk taker. They won't pay them. They will go and pay, they will go and settle their debt holder first. They must settle their debt holder. That is why you have finance cost. When you not have profit before tax, then what's left, that is what the ordinary shareholder will share. So Gordon's growth model make use of what? Accounting profit. Right? So how do we determine the growth rate? Using the what? The Gordon's growth model. Right? Now G equals to RB, where R is the what? The return on equity, the return on investment. Class, please, I want you to pay attention to this part, right? I want you to pay attention very well under the Gordon's growth model, most especially this part of the formula. Now, the R represents, now the Gordon's growth model assumes that there will be a growth in dividend in the future. That is why you see that you will look at your dividend is growing. Gordon's growth model assumes that dividend will grow to perpetuity. There will be a growth in dividend. One, it makes use of accounting profit. That is why you see G equals to growth in the future dividend, where R, the formula is R times B. We give you a growth rate. Now, class, R is equal to return on investment. Now, how do you determine return on investment? Don't forget in your financial reporting. Now, return on investment is calculated as the profit after tax divided by the capital employed. We should not equally forget in financial reporting, the capital employed could be defined as the total asset, as the net asset. It depends on the examiner point. Is that not so, class? Class, is that not so? Now, in this part, or the profit after tax, the profit after tax divided by the opening shareholders fund. Class, in SFM, in strategic financial management, when you want to estimate growth rate using the Gordon's growth model, class, your return on investment, focus your return on investment formula on profit after tax divided by opening shareholders fund. Class, the question now is, what is this opening shareholders fund? You and I can agree with me that, let's say you have from your equity, you have profits, you have from your statement of changes in equity, you have a balance brought forward from the previous year. You have profit for the year. You have opening shareholders funds. Excuse me. You have dividend. You pay dividend. This is your statement of changes in equity. Dividend. Class. You have your retained earning. Let's say you have your retained earning. You know, when you remove your profits for the year, excuse me, you remove your dividend, you have your retained earning. Retained earning. Class. Now, you can agree with me that this balance brought forward here. Let's say it is retained earning for the previous year. Class, please pay attention. Now, this is your statement of changes in equity. I want to explain the opening shareholders fund. Normally, the opening shareholders fund is your total equity, both the ordinary shares and retained earning. You can also have the ordinary shares here. In addition to this, let me add it. Ordinary shares. For those who did financial reporting, will flow. Now, if you have something like this, class, and your retained earning is this, right? Okay. Let's say this is your, let me use this way. Let me use it this way. This is your total equity. Total equity to be this. Class, you should not forget that this is your total equity, and this should be your shareholders funds. But because the formula says opening shareholders funds, what does opening shareholders fund? This should be what you should pick, because you will see something like this in the financial statement. Now, the total equity, don't forget, the capital employed could be as net asset, as total asset, or equity. Now, for the purpose of the cost of capital, it is or profit after tax divided by opening shareholders fund. Your opening shareholders fund is your equity, your total equity. Now, class, this is the retained earning brought forward from the previous year. This is your ordinary shares. This is the profit for the year. This is the dividend, and this is your total equity. Now, what is opening shareholders funds? What is opening shareholders fund? The opening shareholders fund simply means that I only need class. I only need the equity for that year. I don't need the one of previous year. You don't need to add anything that has to do with previous year. That is why it is opening shareholders fund. Or let's say, let me say it is not the previous year. I don't want anything that has to do with the current year. I need the opening. Class, what is opening shareholders fund? Opening shareholders fund means the previous shareholder, the previous shareholders fund, the previous total equity. Class, with this illustration, we have included profit for the year and dividend. Class, we have included profit for the year and what? And dividend. And what we need, it is only the opening, which means the previous year, which means that we need only the retained earning, the ordinary shares only. We don't need the profit for the year as well as the dividend. Don't forget that the profit for the year minus the dividend will give you what? Retained earning. Class. So the opening shareholders fund, it is just for the previous year. You don't need anything that has to do with the current year retained earning. Class. So therefore, what you will now do is for you to remove the current year retained earnings. So you now say retained earnings, right? So it will be profits after tax minus the dividend. You have here, so you remove it so that you will have the opening shareholders fund. Opening shareholders fund. So this is what you will now use, class. This profit for the year and dividend, profit minus dividend, will give you retained earning, right? We give what? Retained earning. So opening shareholders fund means total equity of the previous years. We don't need the current year equity, right? What we need is the previous year, and you have retained earnings. You have the ordinary shares. Just remove the retained earning for that year, which is the profit after tax of that year minus the dividend paid in that year. We give you what we call opening shareholders fund. Class, am I communicating, please? Am I communicating?
Yes, sir.
Yes, sir.
Okay. Okay.
Yes, sir, but I don't
Hold
understand.
on. You understand when you go back to it. Thank you. Oh, just so a minute, please. Please, can someone explain to her? Please, who will volunteer?
I have a
Okay,
question.
Okonko. Okonko. Who is Okonko? Okonko, right? She will explain to her, right? Who will explain to her? She said she did not understand.
I can explain to her, but I still
Okay,
need
please
to
go ahead.
ask a question.
Explain to her first.
Okay, first of all, what is your question? What do you want to know? Where is it not clear, or let's know? Is it from the beginning, or which parts? Let's know so that we'll know where to handle the question.
Thank you. She
The
should
part I
answer the question.
don't, the part I don't understand is how to get the opening shareholders funds. That's the part I don't understand.
Okay, from this solution now, he said to get the opening shareholders fund. There are some things you have to do first before you can get to that. Now, there's something called balance brought forward. Balance brought forward from last year. Let me say we have 2023 and we are in 2024. I want to determine the opening shareholders in 2024. First thing to do is you get your balance brought forward from 2023, which is your retained earning. Because before you can get your retained earning from that 2023, you need to get your profit, and you now remove the dividend paid in 2023. That will give you your retained earning for 2023. That will now be the balance brought forward in 2024. Now, there's something called ordinary shares. We all know that one. So the value of that ordinary shares, you add it to your retained earning from 2023. Now, there is a profit for the year, which is 2024. 2024, you had it. And you know that this is 2024. There is a dividend declared or paid in 2024. So you remove dividend is always removed. So if you remove dividend in that 2024, definitely you get your total equity in 2024. I'm just using years so that you will understand. So you get your total equity for that 2024 because you are working for 2024. So now, to now get the opening shareholders fund, you know that we are in 2024. Please, sir, if I'm wrong, oh, please try to correct
Go
me.
ahead, please. Go ahead.
So you know that we are in 2024. Now we need to determine our shareholders fund for 2024. We have our total equity and our retained earnings that wants to calculate for 2024. We already know to get our retained earning is your profit after tax minus dividend. So that will give us our retained earning for 2024. You now remove it from your total equity you get from the workings you are doing from 2023 that you brought forward. So the total equity minus your retained earning for this 2024, that will now give you your shareholders fund. That means the what you have left is the shareholders fund that you are going to use. That's
Okay.
what I can explain.
Okay. Thank you.
Uh,
Thank you.
s- s-
That is a very
s-
good one.
Sorry, sir.
So,
Sorry, sir. Please,
so,
please.
so,
I want
uh,
to ask a
so,
question.
Leslie. Ibrahim, Babalola, right? So you can
Yes, sir.
ask your
Yes, sir.
question first. You can ask your question.
The question I want to even ask, I've already mentioned it. Assuming we have 2 years and we need to get opening shareholders fund, is it not the one for last year that's supposed to be our opening for this 20? And that's why it's because of the years. Assuming we have 2 years, 2023, 2024. From what I thought to as what is I'm thinking, it's supposed to be 2023 supposed to be our opening for 2024. That's what I want to ask in case we have 2 years. Is it not the 2023 that's supposed to be our opening for 2024, the shareholders fund? That's my question.
Okay. No, you can. Yeah, that is a very good one. But ICANN is very, very. I want to expose every one of you to the worst case scenario that ICANN is not like FM will not be like financial reporting, just like the way you are thinking. Now, FM FM wants you to think it otherwise. We will not give you that leverage that you want to use. Do you understand? Now, they will give you an extract that this is the retained earning, this is the ordinary shares, this is, or they will even they will give you, okay, the profit for they will not even give you the profit for the year or dividend. They will just tell you that this is the retained earning, and you will have your total equity. Now, that total equity that you have, you should know that that total equity, it is not only for that year only, right? One, we have the previous year, the retained earning brought forward. We have the ordinary shares. We have the profit for the year. We have the dividend for that year. So we don't need the retained earning. We don't need the retained earning of the current year. So therefore, you have to subtract. Now, let me give you an illustration. Just a minute. I'm coming. Let me give an illustration to that. I have a question. I have a question here. Why I'm explaining like this is because I don't want it to be like a magic, right? Like a magic. Now, please take a look at this question. Can you see what I can give you? Can you see? Can you see? Now, can you see this question now? Now, the question says you should calculate the Gordon's you should calculate the weighted average cost of capital using Gordon's growth model. Now, look at the information given to you. The ordinary shares and the retained earning. Now, you should know that this retained earning that you have, it is not only for the current year only. It is not only for the previous year only. They have actually included the current year. So therefore, the total of this is the total equity, which include the previous year and the current year. So therefore, you need to remove the current year retained earning so that you will have the previous year opening shareholders funds. Babalola, do you understand?
Sir, 100%. I just got it now. My
Do you
question,
get now?
you've explained it now.
Thank you. Why I'm explaining it like this is because I don't want it to be like, IB, na magic they do for you. So I want you to have the background, the knowledge already. I want you to have like the background knowledge that, oh, this is how it works. So that when we get there, you will not look at it like, why is it like this now? But you didn't mention it earlier. Now, I'm exposing you to that explanation now so that you have more understanding of it. Do you get? So that opening shareholder that you are thinking that the way you taught in financial reporting may not be applicable here. Absat.
I'm very clear. I'm very clear now.
Sir, please, my only question is that retained earnings in bracket there's profit after tax, hyphen dividend. I think it's the only thing that is confusing me. If you can explain that.
Okay. How do we now, Absat? If you want to determine retained earning now, the current year retained earning, how do we determine current? Is it not profit after tax minus dividend? Absat.
Oh, that's minus dividend. I thought hyphen. Sorry.
That's fine. Okay, now let me use it this way, that this retained earning for current, for the current year, where I remove the retained earning for the current year. Yeah, now let's see. Okay. Any other question? Any other question? Remember that we are only defining the R, which is the return on investment. We are only defining the R. We've not defined the B, which is what retention ratio. We've not defined the B. We are only talking about the return, the R, which is the return on investment. Return on investment will be calculated as the profits after tax divided by the capital employed. In your financial reporting, the capital employed will be defined as net asset, total asset, or total equity. Now, in FM, when it comes to FM, right, they don't want to include the current year with anything that has to do with current year information. And that is why you will have, and I said, or mostly what we use here is profit after tax divided by the opening shareholders fund. Your opening shareholders fund is your total equity. Both the previous and the let me say shareholders fund. Shareholders fund is your total equity. Both the previous year and the current year. Now, when you have that in your financial position extracts given to you, you should know that, oh, this is total equity. Oh, if this is total equity, definitely I have to remove the current year retained earning. Remove the current year retained earning because you need the opening shareholders fund. You don't need anything that has to do with the current year. That is why I say, oh, retained earning minus the current year for the current year so that you have the opening shareholders fund. Class, am I communicating? So can we move? Okay. Now, if this is established, class, if this is established, now don't forget that Gordon's is G equals to R times B, right? The R is the return on investment, which we've already defined as this: profit after tax divided by capital employed, or profit after tax divided by the opening shareholders fund. This is mostly applicable. Most times, this is what you'll be using if a question comes under the Gordon's growth model, right? Now, class, B is retention ratio. B represents retention. Class, retention means retained earning. Class, retention means retained earning. Retention ratio means percentage. Retention means retained earning. Class, retention means retained earning. Ratio means percentage. Therefore, when you want to calculate retention ratio, it is profit after tax part minus dividend. We give you retention from the word retention ratio. Now, you already calculate, you have your retention. Now, the ratio, which means the percentage. So therefore, you have profit after tax minus dividend divided by the profit after tax. We give you retention ratio. Class, am I communicating? So that is your B. So therefore, you will now say, oh, growth rate is equal to R times B. Class, am I communicating?
Yes, sir.
Okay,
Yes,
that's
sir.
fine. Okay. Leslie, I thought you want to ask question. Have I cleared? You have cleared the air, right? So
Yes, sir. Yes, sir. Yes, sir.
Okay,
Yes,
that's
sir.
fine. That's fine.
It's just if we start solving, if we start making solutions now, to be entering 1-1.
Okay, that's fine. That's fine. I understand. But you just have to have the idea of what you want to do so that you know where you are going to, right? So that's
Yes,
fine.
sir.
That's fine.
God, I beg.
Who is that?
Nina.
Okay. Now, let's quickly move. Don't forget, the Gordon's growth model is a method of estimating growth rate. Class, it assumes that there will be a growth rate in dividend to perpetuity. And it also makes use of accounting profits. Now, from the formula, you don't see any question they ask you about Gordon's growth model, maybe in writing, you should be able to, like, even from the formula alone, you should be able to write at least one or two advantages and one disadvantage. It assumes that dividend will grow. Class, what are the advantages of the Gordon's growth model? Class, don't forget, the dividend valuation method is only applicable to a company that is paying dividend. What is the formula? What is the advantages? It is based on the market data. How? You go to the market now. So maybe where we extract financial information, maybe London Stock Exchange market or Nigeria Stock Exchange Group or Yahoo Finance, where we extract as a financial analyst, when you extract financial information, right? You will see dividend, you will see company dividend over the years. If you need 10 years, is there. So it is based on what you see in the market. It is based on data. Now, reflect future expectation. Gordon's growth model is talking about that there will be a growth in dividend. Future. Now, it is simple to what? To calculate. Is Gordon's growth model simple to calculate? Class. Is it simple to calculate?
It is simple, sir.
Okay. Now, class, what are the disadvantages? What are the disadvantages? I actually added this simple. So what are the disadvantages? It's because the Gordon's growth model rely on accounting profit. And accounting profit is subjective. You can manipulate accounting profit. Class, it is assumed that it only applies to what? Dividend paying firm. That is one of the disadvantages. It's a problem. Any company that is not paying dividend, you cannot apply the dividend valuation model or the dividend, the Gordon's growth. Which growth did you want to calculate? Now, it is assumed that R&B will be constant. Class, will be what? Will be constant. Class, will be what? Will be constant. Class, the Gordon's growth model makes use of historical information. That is why I have said that if you go to the Yahoo Finance today or the London Stock Exchange, maybe you are looking for Apple, right? Then you check for the dividend paid over the years, maybe for 10 years. It is historical. You are using the historical information to predict for what will happen in the future. So it is based on historical data, right? Don't forget all these problems of Gordon's. From the formula itself, you will be able to establish the disadvantages of Gordon's growth model. It makes use of accounting profit, right? It is only applicable to the what? Dividend what? It is a problem, right? And it makes use of historical data. 4, it assumes that R&B will be what? Constant. Now, we move to the second method of calculating the cost of equity. Class, why you need to understand this? I don't want to jump into calculation because
Sir,
you
another
have
one
to
of
understand
disadvantage I noticed, it is very rigid. I noticed that.
rigid,
Yes.
right? Now,
Yes, very
thank you.
rigid.
Thank you. so you don't need to jump into calculation, right? I can give you calculation now. Let's do it now. No, there are some things you need to understand. In fact, this night, again, we will not solve any questions. You still go back. You must understand cost of equity. We must understand cost of equity before we go to debt, or we can even do debt to some part. Then you go back again and do revision. You get your material, you go back, exclude questions. Questions will not be there. Go back again and do your revision. Make notes. Don't assume that you already understand it. Make your note and ask your question. Right? Now, the second method of estimating cost of equity, class, the second method of estimating cost of equity is the CAPM, which is the capital asset pricing model. Class, which is what? The capital asset pricing model. You can use it to estimate the cost of equity. Class, cost of equity or the capital asset pricing model is a method of estimating the cost of equity. Class, sometimes question will not tell you that use capital asset pricing model to determine cost of equity. No, sometimes. But in that question, if you see some ingredient of capital asset pricing model, then you will now know that yes, for me to determine this cost of equity, I can't use dividend. No, there's no dividend in this question. So I'm to use the capital asset pricing model. Now, capital asset pricing model measures the relationship between minimum individual required return, rate of return, and investment risk. Class, what is this minimum required rate of return? Minimum required, what you are expecting. It is just English. You as an individual, you buy Jitco Bank shares. Babalola will be expecting, that is minimum. You are expecting something. Minimum required as an individual. You buy shares now. Jitko, you are expecting a required rate of return from your investment, which could be either capital appreciation. We could be either capital appreciation. Now, capital appreciation or what, class? What am I expecting for my investment? Capital appreciation or what, class?
Dividend.
Capital.
Dividend.
Thank you. Or dividend. That is a very good one. Or dividend. Capital appreciation means increase in the market price. Now, as Babalola will be saying, I'm expecting something from my investment. That is minimum required. You are expecting something from your investment. And investment risk. Now, you, Babalola, you are expecting something from your investment as an individual. Class. Babalola forgets that there are some risks that will affect this your minimum required return. If you work in a place that they will tell you that it is based on target, you meet up with this target, they will pay you 50,000. If you did not meet up, they will pay you 20,000. There is a risk that you may not meet up. Class. Now, Babalola is expecting something from his investment. And he has forgotten that in the process of expecting something from his investment, there will be a risk of investment. This risk of investment risk is what we call systematic risk. What will affect your return? It is what we call systematic. The question now is, what is systematic risk? Risk that is not avoidable. A practical illustration. The inflation rate, it is not avoidable. Now, the question is, will inflation affect your investments? No, because inflation does not have anything to do with shares. If it is shares, no. Right? But directly or indirectly, it will affect. Because this company that you buy their shares, they will use fuel. They will use petrol. They will use a lot of some resources which they need to pay. Now, if there is an increase in the price, it will affect you as well as an investor. Systematic risk are exchange rates. Imagine you invest, you buy shares from a company, maybe Cadbury, that are multinational companies. Exchange rate will affect them. So definitely it will hinder your return on investment. That is why it's measured relation between what you are expecting and the risk of that investment. And what is the risk of that will affect that investment, right? Is what we call systematic risk. It is known as market risk, unavoidable. Class, if you are going to work, there are some things that will happen that you cannot even say it will not happen. Unforeseen. Class, unforeseen. What will affect a company not to pay you a salary as at the end of the month? Right? You are expecting it and something come up again. Class, am I communicating? So capital asset value is just trying to explain that, it's a method of estimating cost of equity. Yes, it's a method of estimating cost of equity. However, it measures the relationship between what you are expecting, and the investment risk. You are expecting something. There will be a risk that will affect that investment. And what is this risk? Is what we call systematic risk. Class, What is the formula for calculating the cost of equity using the capital asset pricing model? There are two approaches. There are two formula, but it depends on what is given to you in the question. You know, I keep making a reference to question. Question will determine where you want to go, whether you want to use A or you want to use B. Cost of equity is equals to RF plus beta. Equity beta, open bracket, RM minus RF. I know the terms are not familiar. You are not familiar with the terms. Don't worry. So now let's define the terms. Let's define the terms so you understand. KE is the cost of equity. KE is the cost of equity. RF is the risk-free. RF means risk-free. So when you see risk-free in the question, you should know that, and you have to determine the cost of equity using the capital asset pricing model, and you see risk-free. Risk-free, which is your RF. So if they don't call it risk-free in the question, it may be treasury bill. If it is not, if they didn't call it treasury bill in the question, it may be government bond. Then RM is the market return.
That is
RM is
the
what? Who is that now? RM is the what? Is the market return. Right? So YB is the equity beta. The beta factor or the equity beta. That is the systematic risk. That B that you see in that formula is known as beta, is known as equity beta. I will even change it. Known as equity what? Equity beta, which is systematic risk. You can see that from the formula of CAPM, you have systematic risk. And CAPM says that measures the relationship between individual required return. You want to what you want to use CAPM for is to determine cost of equity. And what does it measure? It measures the relationship between Babalola that is expecting something and the risk that will affect the shares of Babalola, which is systematic risk. And that is why from the formula, it now shows that in that formula, there is risk in the formula. That is why we have RF, which is the risk-free. B is the equity beta. The equity beta measures systematic risk. RM, which is the market return, minus RF. Or in the question, if you have what we call risk premium. Now, the formula would now be changed to K cost of equity equals to RF plus equity beta, open bracket, RP. The RP is the risk premium. Now, what brings about risk premium is just like we will compensate you. Premium is like we will compensate you from investing in a risky asset. That is what we call premium. Okay. Babalola borrow me 50,000. And I'm looking at it. Okay, Babalola borrow me 50,000 naira. And Babalola say, oh, you will pay me 100 naira. You will use it to pay me 100 naira. That is 50 naira gain. Now, I will now say, oh, because you are taking a risk, or Babalola will now say, because he is taking a risk to borrow me these funds, I need to add another 15 naira to it, making it 150. I need to add 15 naira to it because of the risk I'm taking, because the risk he is taking to borrow me that fund. So risk premium is like the additional you get, the additional return you get from investing in a risky asset, maybe shares or bond. That is risk premium. But the risk premium will just be given to you in the question. I'm just explaining what is risk premium. Risk premium will be given to you if you are to use the second formula. The question may say, oh, risk premium is 5%. So you should know that you will not use the first formula. You have to use the second formula. So in a nutshell, capital asset pricing model is a method of estimating the cost of equity, and it measures the relationship between what Babalola is expecting and the risk that will affect Babalola. And from the formula, when you have a risk-free rate, I will explain that. Treasury bill, don't forget that government bonds are risk-free, right? What are risk-free? When you move from this stage to SFM, then we will now look at more explanation. Why is it like this and why is it like this, right? But just understand it this way. Class, question. I know this one is simple now. This formula. Kenny.
Yes, sir. I want to ask another question here. Based on this capital asset pricing model and you give to us. Now, it's just show the relationship between the return.
Babalola, can you be audible?
Okay.
You are using bedroom voice.
Okay. Can you hear me now?
Yes, I can hear you.
By this capital pricing method, now, it's trying to tell us the return from investment, what I'm expecting, and the relationship and the risk associated with what I'm expecting. Am I right? So now that means from the definition of that cost of capital before we get to this, and we say that it's a minimum return. Am I right?
Yes.
That means for that minimum alone, is this risk as in the factor in that minimum? That means my minimum might not be minimum again. It can even go below that.
Yes, now they've not even factored the risk or that minimum. That minimum, for you to get that minimum, it means that, let's say they've actually include the risk, that the worst case scenario of what you will get. Do you get? And you should not forget that the cost of equity or debt is a cost to the firm. You are estimating the costs for the firm, Neil, not you as an investor. You want to estimate the costs, their own costs, because they want to source for funds to finance their projects. Do you understand?
Yes, I understand.
Oh, okay. So are we good? Any other question, please? This class is dull. What happened now? Is it cost of capital? Hello? Tolulokwe, are you still with us? Or against us? Tolulokwe, she's not with us.
I'm with you, sir.
Franca, are you with us or against us? She's not with us. Esther, are you with us or against us? I'm not sure she's with us.
So we're with you.
Oh, Bukola.
Solving real life questions. It will be more interactive.
He said?
I said we're with you. Maybe when we start solving real life questions, it will be more interactive.
No, it is not real life. It is textbook question.
Okay. Textbook question.
Yes, because no, there are some things that you look at it. This one is not even applicable in real life, but they just tell us take it like this and move on. You understand? But you need to understand. I cannot just see if I start cost of capital question, you get confused. Like if I just start without explaining all these things, that is double work now. But you have to understand what you want to do. That is why immediately after the class, as they ought, go back and do that revision. Right? You get the material tonight. You just go back and do the revision. Right. So when you see it, you know, say, yes, okay, this is what you need to just do a table, do a formula that, okay, this is what you need to know. Then wait for my questions. And my questions will be from all these things I've been explaining, everything. Right? So it is what it is. So I actually explained systematic and non-systematic risk here. Right? I guess I'm not supposed to bring it here, but that's fine. So you just have the knowledge. I think it is in the other part of cost of capital, but that's fine. Now, don't forget, systematic risk is unavoidable risk. Market risk. So what if the question says explain systematic risk, so that you should not be looking at, if you should not be now be thinking that IB did not teach us systematic and unsystematic risk. We're just explaining practical. Go to London Stock Exchange, go to this, go to that. Now, this is systematic risk, unavoidable risk, general economic factor, inflation, exchange rates, right? It affects everybody. Why unsystematic risk, right? Why unsystematic risk? It is what? Unavoidable, unavoidable. You can't, it is avoidable risk. You can avoid it, or unique risk. You can actually avoid it. For instance, if a company machine break down now, right, and they were not able to like produce a product, what will happen? It is actually caused by the company, right? Why will you wait till machine break down, right? That is unsystematic risk. It can also actually be avoided. Class. So you can keep these assumptions of capital asset pricing model, right? It assumed that assumption of capital asset pricing model, right? No transaction costs. When you want to determine okay, that's fine. Assumptions of capital asset pricing model. Class. Capital asset pricing model is used to estimate cost of equity. That is the minimum you are expecting from your investment. And that minimum, systematic risk may affect that minimum self. You are expecting it. Systematic risk can actually take it out from you, which means you may not be able to get that expected return. Adebisi, who is hosting us again? Adebisi Adegoke. Okay, oh, maybe you want to share your screen. You can go ahead, though.
Sorry, it was a mistake. Sorry.
That's fine. I forgot to remove it on third party. Okay, that's fine. Now, assumption of capital asset pricing model, no transaction cost. I don't want to be explaining all these things in details here, right? No transaction cost, no taxation. You can see that in the formula, there is no transaction cost. Class, cost of equity that you calculate, it is a cost to the firm. It is a return to you, right? Now, it assumes that when you buy shares if a company wants to raise fund, maybe using equity. Equity could be right issue, could be public offer. You get a note on your sources of finance, could be right issue or public offer. Now, let's say Babalola want to buy shares. Babalola buy shares from maybe Jitco, and you cannot just go to the Nigeria exchange market and buy these shares. It is not possible. You have to pass through a stockbroker. Maybe probably one of the guys, one of the stockbrokers, maybe United Capital and some other brokers, right? And they will charge you in the process of buying that shares using that particular stockbroker, right? Right? Using that particular what? Stockbroker. They will, in the process, they will charge you. There will be a transaction cost. If you want to buy shares, there will be a transaction cost. If it is 15 naira, you had maybe 2 naira or 10 naira. So it's an assumption that you will not incur transaction costs when you want to buy shares. Because when you buy shares, you are expecting something from your what? Investment. No taxation. It is an assumption because before you will arrive at your profit after tax, before they will pay you dividend, they will already consider tax. So that no taxation is an assumption. It only considers systematic risk. Of course, the equity beta you see, the beta you see that in that formula, the B that you see, B is equity beta. That is systematic risk. It only consider systematic. It is only say that any other risk does not affect the minimum return that you are expecting. The only thing that affects it is just systematic risk. So it's assumed risk-free, homogeneous expectations, all these things. As we move, I will explain them in details. Now, let's quickly move. We'll come back to this part of beta. Now, class. Okay. Do we have anyone who is confused in this class? They are confused. Say, class.
Hey,
They play. See, just they play. Are you just joining us for the first time? Maybe you are just joining for the first time.
No, sir, I'm not joining for the first time.
But did you go back to the previous lecture? Did you actually go back to the previous lecture?
yes, I was only joking.
Okay. Okay, that's fine. Because there's no how you go back to the previous lecture and you will not understand where we stopped and where we are today. So you say, I beg you. Honestly, you just have to understand it, right? And that is why I just have to bring out so many things that the worst case scenario you could see so that you will not see. I don't want to bring questions. I can just go and bring questions that you can do it in less than 10 minutes. Then you look at it that I don't start because of capital. They play. See, they play. Because you don't know. This is FM. The first time ICANN will bring FM. So in ICANN, not in ACC, in ICANN, you don't know. You don't even know how they want to set the question. Right? You don't know how they want to set the question. That is why I have to expose you. Class, I have to expose you to the worst case scenario that you could see. So please follow. If you don't understand, just let me know. Just say, IB, I don't understand this. So then I'll go back and do what? And explain it again. Now, assumption of capital asset pricing model. I've talked about it assumes risk-free asset. Class, there's nothing like risk-free asset in capital asset pricing model. Don't forget, capital asset pricing model is used to estimate the cost of equity. Cost of equity is equity equity holder are risk taker. They are not, it is not, risk-free asset means that if you invest in these shares, there's no risk. Is it possible? So you could see that in the formula of CAPM, you have risk-free, which is the treasury bill that was stated. Treasury bill that you have risk-free treasury bill. It is an assumption. It is not possible in capital asset pricing model that you want to use to estimate cost of equity. An equity holder are risk taker. And you are saying that it is risk-free. Class, how is it risk-free? When I'm a risk taker and you're telling me that it's risk-free, it's an assumption. That is what I want you all to understand. That it is an assumption. That there will be a what? It is a risk-free. Homogeneous what? Expectation. Homogeneous expectation means that Babalola, Deborah, Tolulope, we are expecting the same thing. We are expecting that if I buy Jitco Bank shares or Fidelity Bank shares or Zenith Bank shares now, then me, I will gain 50%. Deborah too will be saying, I will gain 50%. The other person, our expectation is different in the market. Class, Deborah may say that I don't want to go for capital appreciation. I want to go for dividend. Now, Babalola will say, I want to go for what is it called? Capital appreciation. You can see that we don't have, our expectations is not homogeneous at all. It's not homogeneous, it's an assumption that we are, as you are thinking that you have everybody want to go for dividend. That is homogeneous. We have the same expectation. No, investors don't have the same expectation. Everybody have different view, right? So the limitations, Babalola. Okay, now the limitations of capital asset pricing model. Beta factor is unstable over time. It only considers system. Don't forget that capital asset pricing model assumes systematic risk. That the only risk that affects your investment, your return, is only systematic risk, which is not possible. What about unsystematic risk? That can be avoided. Anything can happen at any time, and they may not produce. And if they are not producing, how do they want to make profit? How do you want to get your return? So it's only considered systematic risk, that the only risk that affects that your expected return, it is only systematic risk. So, and so on. So you may see a question like this, that, what are the assumptions of capital asset pricing model, or the limitation of what? Capital asset pricing model. Lastly, before we quickly do a brief recap again of equity, better measure systematic risk. Better measures systematic what? Risk. What is better? They ask you what is equity beta. Don't forget that this beta or equity beta is extracted from this formula of CAPM. This is it. It is called beta. You can call it equity beta. This is it. Beta. Systematic risk. Can you see? Can you see it? So, lastly, better measures systematic risk. The question is, don't forget, we already talked about it in the previous one, that better is talking about means systematic risk. That is unavoidable risk. Now, if for those who are finance, I'm not talking about the finance. So I'm talking about the finance. I'm talking about maybe the investment analyst, the portfolio managers, the senior financial, for those who do research, who are research analysts, right? They will go to, if you check very well, companies, a listed company normally have beta. Now, when you look at it, beta is systematic risk that affect everybody. Risk that affects me is affecting you. Now, be inflation don't carry all of us waka. It's affecting all of us now. Is that not so? Is that not so, class? So, a beta greater than 1. When you see a beta, maybe in a question, you see a beta of 0.2. 0.2 is less than 1. And you see a beta of 2.1. What is the implication? Now, when a beta is greater than 1 or less, when it is less than 1, it indicates that the company stock is riskless. That is, there is no risk in that stock, in that company stock. And if there is no risk, we should not forget that the higher the risk, the higher the return. The lower the risk, the lower the return. So you should not be expecting high return if the stock is not volatile. If the beta is not, if there is no risk. So if there is a low risk, if it is less than 1, it means that the company stock is riskless. You don't have enough risk. It is not risky at all. There's no risk in that company stock. Some investors who are not risk appetite, who are risk taker, may not buy shares in that company because they will look at it that their return will not be high, Joe. Beg. I need something that will come, So, but risk appetite, those who risk adverse investors may look at it that it's an opportunity. Let me quickly buy because I don't want anything that has to do with risk. Adverse investor, risk adverse, right? So risk taker will not. So when it is greater than 1, when you see a beta, you have 2.1. It means that the company stock is volatile, is risky. So these are two marks that you may see from your question because I've done a lot of research work on financial management. So I'm projecting the worst case scenario. So that is why I have to go and bring out all these things so that you go and read it, you go back to the video, watch again. Now, in our next class, I'm thinking of bringing a question, but at the same time, well, let's see how it goes. So I don't want to hear, IB, I've not gone back to the previous lecture. When is our next class?
Tuesday.
Tuesday.
Okay. Tuesday. Right. So we are not rushing, we are not rushing, right? But just be rest assured that we'll cover the major one. We'll cover what we need to cover, right?
Ukraine.
You see?
We be Ukraine.
See this guy. So class, do you have anyone who is confused or like this is debt too? We never even move to debt. we are just in equity. We are just playing with equity. We are playing. You can see that it's not difficult, right? Please stay away from those people who have negative. I know some people will be telling you that leave FM. Class, if you leave FM, this diet, next diet, sure you go leave FM. You will still do it. And do you know what? Do you know what will come out? Maybe it's even what you even know. But because of my friend did not take FM, me too, I don't want to take FM. Please make sure you take FM. FM will be sweet, this diet. You don't get? Just follow, get your material, follow the instruction. Class, I will do everything for every one of you to pass FM. Leave the research work to me. I will do it. I will bring in the worst case scenario question. Who is that? So I will bring in the worst case scenario question that you could see in exam. The worst case you may see in exam. So prepare for it. There's nothing in FM. Prepare for it. All you need to do, leave the research work for me. I will do it. I will get the material for you. Go back and read, right? Look at it that you can do this. You can attempt it. There is nothing that is there, right? Please, do we have anyone that have question? I don't want to go to debt. Or should I move? Should we move to debt?
No, sir.
You say?
No, sir.
Okay. Let's quickly. No, sir.
I will let this one digest. So,
Move to debt now. What's the news? What is the new?
So
please
class.
let this one digest.
So, so let me quickly introduce us to the cost of debt so that we can go, right? Cost of debt is the cost to the firm. It is a return to the debt holder. A company, let's say, I think early this year or last year, I think one of the company want to raise funds from the money market. If I say money markets, I'm talking about debt instruments, right? They want to raise debt. I'm talking about debt. They want to raise funds from the market. Now, they issue a bond. They say they want to raise a bond of 50 million. And this 50 million, any investor who will come and buy some of this bond is entitled to 27% per annum. Now, you that will come and say, oh, 27% per annum, it makes sense. So, do you know what the company wants to use the money for? They want to use it for investment. They want to use it for operations. It could be for their operation. It could be they want to do anything, capital investment or anything. So it's a source of finance. So you go there and say, oh, 27% makes sense. Oh, it's above inflation rate. That makes sense. So I will be any return that is above inflation rate. Makes sense. You buy it. You have become a debt holder. The company is owing you. There is an obligation that the company is owing you and it must pay back. And before you will go and rush it, before you go and buy the bond, you do your due diligence. That is why you need a financial expert who will analyze the company financials. So cost of debt is a cost to the firm, is a return to the debt holder. Class, I use something as an example here just now, that 27 return is what we call interest rates. That this is what you will get on your investment on a monthly basis, or on a yearly basis. 27% is the interest. So you as the owner, you go there to buy the bond, you are a debt holder. You are not expecting it. You will take your return on investment, which is the interest rate, on that yearly basis. Now, cost of debt, right? Cost of debt is a debt is the cost to the firm, is the return to the debt holder. Now, cost of debt requiring the company to pay back the interest and principal to the debt holder at the date of maturity. You pay me back because there is an obligation, there is an agreement, there is a covenant. Now, debt is divided into two. Debt is divided into two. Traded debts and non-traded debts. I will leave you with this. Debt is divided into two. Traded debts and non-traded debts. What is traded debt? Traded debts are debts that can be traded in the what? In the money market, in the market. It is a debt instrument. You can see it can be traded. It can be issued to the general public. That is traded debt. Non-traded debt, you cannot find it in the market. If I say market, money market, where people go there and borrow money, you cannot see non-traded debt because it is not traded in the market. It is not. A typical example of non-traded debt is bank loan. Class is what? Is bank loan. The cost of now we pick the traded debt. I will only explain the cost of redeemable, then we go. Now, under the traded debt class, when a company, we should not forget what leads us to cost of capital. When a company wants to finance a project, as a financial manager, you make an investment decision. You've identified the project. Then your CFO will now ask you, or the director, Babalola, how do we finance this? So as a financial manager, you know, okay, we can do equity, or we can do debt. Which one is preferable? Oh, Babalola will now say, excuse me. Babalola will now say, oh, cost of equity is usually higher because they are risk taker. Cost of debt is usually lower. Class, am I communicating, please? So Babalola will now say, oh, okay. Or the director will now say, okay, so which one should we go? Okay, let's go for this. So there is what we call traded debt and non-traded debt. What you can see, if you go to the money market today, in the market, you can see it. It is traded debt, bond, convertible, you can see them. Non-traded debt is bank loan. You cannot see them in the money market because they are short term. You can't even see them. You can't see bank loan there. And what is cost? What is now? Let's pick it. Traded debt, irredeemable debt. The question is, what is irredeemable debt? Irredeemable debt are debts that cannot be paid back. Is there anything like that in practice? That is why you say, it does not exist in practice. You cannot have an irredeemable debt. Are you telling me that if you borrow me, if I'm owing you, I will pay you till perpetuity? The debt, they finish. Is that not so, class? Babalola? Are we still together, please, class? Are we still together?
Yes.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Right? So, irredeemable debt does not exist in practice. Are debts that cannot be redeemed. You'll be paying it down. It doesn't have a maturity. The company will be paying it. So the question is, how do we determine the cost of irredeemable debt? So in our next class, we'll be looking at the traded debt and non-traded debt cost. You can see that I settled down, like I did not rush this cost of capital. I'm taking it one after the other so that it will give you time to go back, do the revision. Now, let's solve question because you have revised it. It may be difficult now because it may be difficult for me to solve question now because you may not flow with me. Yes, you have to go back and write. Right? And write. So in our next class, we look at the cost of irredeemable debts. We pick it up from traded and non-traded debt. Distinguished professional colleagues, I hope I've been able to do justice to this part. Grace does not work in an isolation. You cannot sit down one side and be saying that I want to pass this exam, I want to pass this exam, or I must pass this exam, and you are not making efforts. It's not possible. You cannot say you want to become a resourceful chartered accountant. You don't do research work. You don't attend you don't attend conference. You don't upskill. You don't do what people are doing. Right? It is not possible. It is not a rocket science. You have to practice it. You have to study. If truly you want to pass, success, grace does not work in an isolation. On this note, have a wonderful night rest. Thank you so much, everyone, for joining. For those who are just joining us, right? Do you have anyone that is just joining us for the first time? Who is joining us for the first time? Unmute your mic. Can you introduce yourself? Do we have? I guess
Yes.
no. Okay.
My name is Victoria. I'm just joining us.
From where? From where? From Port Harcourt?
Oh, you mean my location?
Yes.
From Lagos.
Oh, Lagos. Thank you, Ayola. Thank you. So who again? Who is just joining us for the first time? My name is Ibrahim Akindele. Right?
My name is not Ayola. My name is Victoria.
I know. No, I know. I know. So,
Hello, my name is Peter Jimmy.
Oh, Peter.
Peter Jimmy. Though it's not my first time, but I've not really been up to the end of the class, but today I was able to. Yeah, Peter Jimmy from Lagos State.
Okay, that's fine.
Yeah.
Who again?
Thank you. Yeah.
Hello.
Who again? Yeah, I'm with you. Amina.
Yeah, my name is Amina.
Okay.
Yeah,
From
from
where?
Lagos. Yeah, Lagos.
From Lagos. Okay.
Yeah,
Who again? You're welcome to Next Gen Professional Associate. My name is Ibrahim Akindele, and I'm the lead tutor of the Great Institute, right? Next Gen Professional Associate. And you can see I'll be taking you 100% of financial management. Okay. Why performance management is just 60%. My boss, Mr. Razak, will take 40% because he actually taught me, right? The person that is taking the second part of PM, he taught me cost accounting when I was in Polytechnic Ibadan. So thank you so much, everyone, for joining, and get your material. I will update the folder now. I will update the folder, right? I will update the folder now. So thank you so much, everyone, for joining. Please, Grace, remember this. Grace does not work in isolation. Immediately after this class, it will be up. It's already on the YouTube. Just go live or go to the playlist. You will see the recording of today's class. Remember, grace does not work in an isolation. You cannot sit down and be saying, I want to pass exam, and you are not working. You are not putting effort. Next Gen Professional Associate started last December. 2 months to exam. 2 months to exam. Guess what? Last diet, we qualified 68. We had 68 qualified chartered accountants. It is efforts. We work for it. Class, everybody, you and I, as you are working, as you are reading, as you are studying, me too, I'm doing, because I need to deliver. Is that not so? I need to, right? So thank you so much, everyone, for joining, and enjoy the rest of your evening. Thank you, and bye for now.